good morning, everybody. Happy Friday. Welcome to this week's long-form episode on Mining Stock Daily. I'm Trevor Hall, your host and president, CEO of Clear Commodity Network. Here on this Mining Stock Daily long-form, we welcome back Jim Bianco of Bianco Research. Thorough conversation, not necessarily about mining or the metals, but really about big picture scenario with the macro. And interestingly enough, I will admit I've been a little bit pessimistic with a number of the headwinds in the equity markets as of recently, and credit markets as well. And I actually found it pretty pleasantly surprising that Jim provided a lot of optimism to kind of find some equilibrium as well in this conversation. So a wonderful conversation with Jim on all things macro, worth a full-length listen. Special thank you to Visa Silver, Integra Resources, Equinox Gold, and Revival Gold for their continued support of Mining Stock Daily. Let's jump into my conversation with Jim. Have a wonderful weekend, everybody. Be well. It's about once a year we get to sit down here with Jim Bianco from Bianco Research and the magician from Marquette, as I like to call him. Jim, good to see you. How you been?
I've been good. Thank you very much. Coming to you from a hotel in New York City.
Okay. Well, not from your basic your standard office in Chicago. How is Chicago this summer?
It's been a little cool, but it's not so bad. We haven't gotten those 90-degree days yet.
Yeah. Enjoy the coolness before the real summer sits in here. But hey, we got a couple things to talk about. Just a few. In fact, I got about half a dozen bullet points here of big topics I want to tackle with you, because the big picture of things, Jim, we can talk about Iran, this MOU, what's in these 14 points, who wins, who loses. But on top of that, there's, the tides are rough in the AI trade right now following the SpaceX IPO. We got to talk about inventories, just a number of things, but it all just seems, on the grand picture of things, all these turbulent narratives are really starting to kind of funnel and almost crash into one another to a point where, and I don't want to be incredibly pessimistic, nor do I want to be a complete doom and gloomer, but there's a lot of headwinds in front of us. And despite the market really trying to make new all-time highs here in the last couple of trading days, once again, the narrative is still positive. Traders are still putting capital into positive reflection of what, looks good and feels good. But let's start with this MOU. Jim, I just don't see anything in here that says, U.S. walked away here with any sort of a benefit. I don't see it, other than maybe oil coming back online.
Well, that's it. And hopefully, as we discuss this, I'll give you a bit of a positive spin on some of this stuff. But let me start with the MOU, as I like to call it. Trump came out today, a couple of hours ago, and said they're still working on the text. Even though he signed it on Sunday, they're still working on the text of it as well. But you're right. It's hard to really position this thing as some kind of a positive for the U.S. But we're an investment channel, so let's talk about what we care about, and that's the price of crude oil. And I think what the bond market, not the bond market, but the energy markets and the financial markets have come to the conclusion of is the U.S. wants crude to come out of the Strait. The Iranians want crude to come out of the Strait, and the other Gulf nations want crude to come out of the Strait. And so crude's going to come out of the Strait. And that's one of the reasons why you've seen the price of oil be very well behaved. There's nobody that really doesn't want it to come out right now. And to that end, the reason that oil has been well behaved is because we've been drawing down inventories aggressively, whether it's strategic reserves or it's China not importing as much because they're drawing down their reserves. So it's kind of the same thing. And that status quo is probably going to stay in place until one of two things happens. Either we go back to shooting at each other and, we inflict that's one of the reasons why Trump is not shooting at anybody. Yes, I think ultimately at the end of the day, he's not a peacenik. He's afraid that if he starts shooting at everybody, $150 crude oil. That's I think the reason why he's not doing it. So unless we go back to shooting at everybody, the price of crude oil will stay well behaved unless we get to what some of the oil analysts call tank bottom, meaning that we run down our inventories to make up for that loss of oil until we can't run them down anymore. Now, nobody knows where that is. Maybe that's in a month or two, maybe that's 6 months out or something like that. So I think that the takeaway with the memorandum of understanding and everything is let's cut it through. Everybody wants the price of oil down. Everybody wants oil cargoes to move. Everybody wants that. And that's what we're going to get. And that's what the price of oil is reacting to.
Oh yeah, it's definitely narrative driven. It's not necessarily driven by mathematics or actual data anymore. It's specifically with the crude inventory data we've seen in the last month and a half. In fact, so we are recording this Wednesday morning. There's some expectations of what this week's inventory draw will look like with the SPR and the commercial drawdown in tandem. It could be a big number. In fact, some people are saying it could be the largest inventory drawdown that we have ever seen. Now, there has been a lot of moving factors that have kept the price of oil, negligible, intact here. But are we running on borrowed time here, Jim?
Yeah, because I think really what the assumption is in the marketplace among governments with strategic reserves and among the industry with commercial reserves is this won't last long. So open the spigots, drain your inventories to keep the amount of oil supplied to the world at the same level it was before the Strait of Hormuz closed. And it's working because there isn't really a shortage. Now the price is up some. I mean, it's down, but it's still at $80 or so when we were $60 before the war started. So it's not completely reversed. But that's what we're doing. Now you could argue open the spigots and drain your inventories to keep the world supplied is reckless because what happens when you run your inventories down? You've got nothing left. You're vulnerable. But the assumption is we don't have to worry about this long term because this will get sorted out soon. And that's the assumption that everybody is operating under. So I think that that's really, like I said before, that's really the assumption that's driving all of this. This is temporary. This won't last very much longer. So bridge the gap by draining inventories. And it might work that way because, as I said, everybody wants this to be temporary. President wants the price of oil down. The Iranians want their tankers out. Of course, the rest of the Gulf states want their tankers out. They all want the same thing. And that's why I think everybody's operating under that. This will be temporary. There's nobody out there that is really standing in the way of preventing any of these tankers moving. Not even the Iranians. The Iranians just want money. Just pay me a toll and your tankers can go through.
Hmm. Well, I think there's a couple of things on the hindsight we are forgetting about. That would be the sweeping of the mines in Hormuz. Like how long that takes is still to be unknown. And also those pesky little barnacles that made made the headlines a couple weeks ago, Jim.
Yeah.
Are those things to be concerned about? Like if this Article 4 within the MOU says Iran has up to 30 days after signing to restore the strait traffic, like are we forgetting about the mines and the barnacles?
Well, a couple of things. I mean, if we allow the Navy in, to go get rid of the mines and the Iranians won't shoot at them while they're doing it, that won't take very long. What
Okay.
takes it very long is when you have to do it in a wartime. When somebody's shooting at you, you have to do it, or the potential that somebody could shoot at you. That's what complicates it. So if you remove that complication, that could be done. The barnacles, yeah, I mean, I get that, but one of the things is if you look on marine traffic, the AIS of whatever ships are still broadcasting in the Persian Gulf, you'll see every couple of days they start doing little circles and stuff, and that's because if the ship starts moving, it keeps the barnacles off of it. So they're starting to, they're working on it. But you're right. This is going to be an issue. but it's nothing that can't be resolved if the strait gets open and these ships start moving again.
Sure. Yeah, I'm certainly not questioning the resolve. I am questioning the timeline of all this and where it sits in the framework. But position risk in the equity market or whatever market you're in has been very interesting through all this. The battle online between the oil bulls and the oil bears has just been one dialogue to watch, and I think everybody who's been following me on X knows where I stand. But Jim, how about you? How do you think about position risk when this narrative and the physics of this market are running on different timelines?
Yeah, this is not unusual. I mean, we saw kind of the flip side of this in 2022, right? Because in 2022, when the Ukraine Russian war started, the market completely overreacted to the potential loss of 4 million barrels a day from Russian production and shot the price of crude oil to $125 by June of 2022, and then realized we overdid it, and then the price crashed. And now we're doing the opposite. We're looking at like 11 million barrels or maybe 15 million barrels as much, being constricted from the strait and going, it's no big deal. We don't need to take the price up. So maybe we're going to see this eventually resolve, kind of like the inverse. We overdid it in 22 by taking the price up, then we brought it down. Maybe we're underdoing it by not taking the price up now. And if constricted supplies last to some degree, or like I said, everybody wants the price of oil to move, and they can't get it to move, it will start moving higher. I still think the risk is to the upside right now. I think at this point, when you're down at $80, I don't know what a short is going to get you at this point in crude oil. The short was when it was 110 and 115. When it's 75 or 80, that's where you should be covering the short. You shouldn't be establishing a new short, at this point. And so I think the risk is definitely to the upside.
Yeah. I'm going to do my best to ask you about inventories, but I do want to move on to other topics of the market, and we will talk about metals and mining and its place in all of this, Jim.
Mhm.
But we mentioned the inventory headlines here, and again, Wednesday morning as we speak, we haven't gotten those official EIA numbers, but we do have kind of expectations that have been published this week. The expectations is somewhere between one of the higher inventory drawdowns in a week to the highest. So we're talking between 17, 19 million barrels of inventory draw on the commercial and SPR side. So if we do get that largest single week draw on record history, what does that look like for markets? Do they respond to something like that? Do credit markets start pricing in any physical reality in this? And it would be interesting to have those numbers hit, the same week Fed's Warsh is giving his inaugural presser. I mean,
He's
again,
giving it in 3 hours.
all
Warsh is
these
speaking
things
in
are
3 hours.
funneling. I know all these things are funneling like all into one another at the same time.
No, again, I don't think that the inventory reaction will be that big, even if it is, a massive draw, because the market thinks that everybody wants oil to move. So
Mhm.
don't worry about it. Now, where the problem might become is on the flip side. Once the oil starts moving, and this is again why I think you should be covering your short. We're not, the president's like, well, we're not going to go back down when the war ends, we're going to go right back to where we were before the war, if not lower. I don't think we're going to go to $50 if the war ends, because we have to replenish the inventories at some point. So it's going to give you excess demand. It's going to keep the price up. Now, it's not going to keep the price at $100 to replenish those inventories, but that's why I think we might be stuck at around $80 for an extended period of time as we kind of get the inventory straightened out. So, yeah, I don't see it being an immediate problem, but the problem with war is everybody's on the same page. They all want the oil flow to move. And funny
Yeah.
thing about war is that might not be good enough to get the oil flow to move. You have to actually end the war in order to get the oil flow to move again.
Yeah. Well, the inflationary scenario was still pressurized even going into this into this timeline with Hormuz and the volatility in the oil market. And on top of this, we are seeing new data. We've seen manufacturing new orders collapsing, pull forward. Our friend Peter Bookvar writing daily about how pull forward of orders of basically that demand has been propped up, but that's over. So how do you sit this kind of do you think we're in a stagflationary environment now? Have we stepped foot in it just now, or have we been in this for maybe the better part of all of 2026?
Well, I mean, you cited some negative statistics. I mean, the positive statistics I would cite to you is that the employment numbers have been pretty good the last few months,
Fair enough.
especially when you adjust them for population growth. Remember, the biggest driver of employment in the biggest driver of employment in any country, not only the United States, is how fast is your population growing? And the answer to the US is it's barely growing at all because the biggest driver of population growth is immigration, and we don't have any right now. So when we churn out 100, 120,000 jobs a month, you might think, doesn't that sound kind of average? Well, not with this population growth. That's a very strong number. Retail sales has been very strong. What's driving retail sales is the top of the K. Top of the K is making money in equities, it's making money on their house, according to Zillow. They're spending money. Bottom of the K is struggling, but the reality is the bottom of the K doesn't move the needle on the economic data. It's the top of the K. Uh, um, I mean, I wish it was a little bit more balanced out, but it isn't right now. So all in, I think that the economy is doing okay right now. I'm not worried about the stag part of the equation. What I am worried about is the deflation part of the equation. We do have inflation. We have 4.2% on CPI. I was going to say unemployment, 4.2% CPI, and core inflation. Like, well, that 4.2 is all oil prices, gasoline prices going up. Fine. Core inflation is approaching 3.5%. That is that should be for Kevin Warsh at his first press conference. He should say that is flat out unacceptable. Full stop. End of discussion. Do not try and rationalize that number. And we'll have to see whether or not he does, because we've never seen him at a press conference before. We'll see him later today at that press conference. But the point is that the inflation part of the stagflation is real. I'm not so sure the stag part of it isn't. So what does that mean? Well, if you have inflation and decent growth, nominal growth in your economy is going to be strong. Why does that matter? So I'll ask a question and I'll answer it.
Okay.
Why does countries like Venezuela have 100% interest rates? Why do countries like Japan a couple of years ago have zero interest rates? And the answer is, how fast is their nominal growth? Nominal, real growth plus inflation. If you're Venezuela, and I'll give you some inaccurate numbers to get my point across, and you have 110% inflation and a minus 10% growth and 100% nominal growth, because it's all inflation, you should have 100% interest rates. If you're Japan and your real growth and your inflation equals zero, you should have zero on interest rates. So if we don't have the stag and we have the inflation and the economy is moving stronger, interest rates will go higher. And that's what I think we're starting to see in interest rates right now, is they've been moving higher. The 10-year yield before the war started was 395. Today, it's 446. So it is moving higher. It's 50 basis points higher than it was at the start of the war. And I think that the risk is that those rates continue to go up.
Hmm. That would be a incredible battle between the market itself and the Federal Reserve. And so we can get into a discussion about how a Kevin Warsh FOMC would battle such, a move higher in yields. Are we on the precipice here, Jim, of some policy that many would like to call yield curve control? Do you think we're closer to something like that being set in?
I hope we're not. I hope we're not. And I want to say because of that, no. And the reason I say I hope we're not is yield curve control has 100% track record in that when you first institute it, it works for a while and then ends in a catastrophe. You can get into it, but you can never get out of it without wrecking everything. the Reserve Bank of Australia, ask the Bank of Japan. Everybody who's tried this, it works for a while and they pat each other on the back, and then it goes sideways and interest rates go vertical and they can't control it and everything else. So I hope we don't, because I use the analogy of the yield curve control as somebody puts a grenade on the table and pulls the pin, and we all sit around and argue when it's going to blow up. Well, it's going to blow up and we're all going to die. So, maybe we shouldn't even get to that point in the first place, because that's essentially what you've done is you've pulled the pin on a grenade and it will eventually blow up on you. And the reason it blows up on you is what you're arguing with yield curve control is we're going to take away the setting of interest rates from markets and we're going to give it to a government body. And they're going to force those interest rates at a certain level. Well, the very first day they do it, it might work. But eventually, they're going to set those rates at the wrong level. And they're going to create all kind of distortions and problems in the real economy. And then eventually those markets become, dysfunctional. And that's what you have to be careful of when it comes to yield curve control. Eventually, you'll set those rates at the wrong level. And what's the wrong level? Too low. Too low is the wrong level. Let me conclude with this. Our president is a real estate guy. The memorandum of understanding is a real estate thing. He talks about that the Iranians are tapping him. That's a real estate term. Everything he thinks about in terms of is real estate. And his two negotiators, Woodcoff and Kushner, are real estate guys as well. Real estate people, and I'll say this with all good due respect to my real estate friends in the audience, real estate people never ever take your investment or interest rate advice from them ever, because I keep saying investment. Their interest rate advice is simple. Lower, like the president believes, is always better on interest rates under any reason, and higher is always worse. And the perfect interest rate is 0, according to them. They do not understand that there can be a thing called a too low interest rate. Yes, there can. Because if an interest rate is too low, what it does is it creates problems in your economy because bad investments get funded. Bad ideas can get funding because they can afford too low an interest rate. And that's what creates problems in your economy. So if we go to yield curve control, what we're saying is we're going to make interest rates so low that shitty investments can survive. And if we have enough shitty investments in our economy surviving, we're building buildings we shouldn't be building. We're starting businesses that shouldn't be started. Why? Because money's cheap enough that we can do it. It creates a problem at the end of the day. And that's why I don't think we want to go there.
Hey, stay right there. We'll be right back after a very short break.
In mining, the difference between a good project and a great investment often comes down to one thing: visibility. Terra Hutton is a Sweden-based mining investor platform built to make the invisible investable. Even the strongest project can be overlooked. Geology is inherently complex and data-heavy, and when it's reduced to raw numbers like drill results and technical reports, investors can miss the story, and companies can miss out on investments. Terra Hutton brings mining projects into the digital spotlight, combining data, narrative, and context in one place, so investors can see not just what a project is, but why it matters. Whether you're evaluating early-stage exploration or more advanced development assets, Terra Hutton helps turn complexity into clarity and information into insight. The kind of transparency that builds loyalty over time. Visit terrahutton.io to learn more.
Hi, I'm Rory Johnston, host of the Oil Groundup podcast. I'm also the founder of Commodity Context and have been an oil market analyst for more than a decade. What I love about the oil industry is that it is both unquestionably essential to our modern life, and the supply, demand, and pricing of this indispensable product is driven by an ever-changing cornucopia of geological, geopolitical, and technological developments. Listen as I speak with experts across the industry to explore everything you've always wanted to know about what's moving the market for black gold. Find the Oil Ground Up podcast on Apple Podcasts, Spotify, and at clearcommodity.net. Brought to you by the Clear Commodity Network, digital news on the physical markets.
Do growth stocks fit into that narrative of things that shouldn't be financialized but yet are? And I say that I don't know if you've read Ed Zitron's latest blogs yet. He puts out on his where's your Ed at? But he's been writing about the AI build out.
Yeah.
And how much of a farce this is. In fact, one of the latest numbers that he wrote about on OpenAI financials, audited, showed a net loss of $38.5 billion last year, Jim. But yet they're going public. They're going to hit this market, but and we're going to fund them. You know, it's going to happen. But but we can do it because of where interest rates are and where the market wants them to be, lower. But this is a dangerous situation we're in.
I'm going to give you the positive story on this.
I love it how I'm coming at it from one side of negative, and you were like, I'm going to show you some positive. I love it, Jeff.
All right. I don't think it's interest rate driven at all. I'm going to argue to you. Let me start off with a premise up front. That we are a digital economy right now. This economy, the modern economy, cannot function properly without the internet or computers or software. And that is what drives everything. You and me couldn't talk without this stuff right now. The problem with all of this stuff is software. We spend SaaS, software as a service, monthly software costs. We as a global economy spend $400 to $500 billion a year on software. And that is whether it's Microsoft or Office or Teams or Zoom, or it's some other kind of software to help edit our emails or whatever we wind up doing, $400 to $500 billion a year. We have the average computer, I'm talking corporate computer. I'm trying to set the premise up. The average corporate computer spends more on software in a year than the cost of the computer. And it's about $1,500 a year as far as what we spend on a corporate computer on software. All this software doesn't talk to each other very well. So the average corporate worker spends a couple of hours a day trying to get some information off the internet into an Excel spreadsheet, cleaned up into something that they could put into an email, and then put together a list and send it to people. What is AI going to do? Get rid of all that shit. It's all going to go to zero, is what it's going to wind up doing. Because what the future computer is going to be is a context window. And I'm going to just say to my computer, I'm going to probably use a microphone. We might not even use our keyboards anymore. Well, they'll still be there, but we hardly use them. And we're just going to tell our computer what we want, and it will give it to us. We don't have to go find it, put it in a spreadsheet, figure out why this won't copy properly from the internet page into the spreadsheet, spend all this time cleaning it up, putting it in this format, putting it in this. Just tell your computer, go get this data, put it in a table, and send it to so-and-so. Done. And that's it. And we're good. And that's where the promise is. That's why the AI-related stocks are not just the Mag 7, they're also the semiconductors and the computer equipment makers and everybody else. They are 48% of the S&P 500 right now. That is the most concentrated the S&P has been on one single theme since the railroads in the 19th century. Now, I'm going to argue to you, it should be that way because this technology is as important as the railroads of the 19th century. The railroads of the 19th century took a big, expansive country, and it took you 4 months in a covered wagon to cross the country to 5 days on a train, and that completely transformed this country. That's what AI has the potential to do for the modern economy. Where are we going to get all the money to pay for this? That $400 to $500 billion a year of SaaS software, not going to need Microsoft Office. You're not going to need Salesforce. You're not going to need all that. You're not going to pay them any money anymore. You're going to roll that all into AI. You want an example of what I'm talking about? Why do we all, here's my phone, why do we pay $1,100 for an iPhone and you don't even make a damn phone call on it? Because it's a camera, it's a video recorder, it's a stereo, it's a GPS device, it's a note taker. So the reason that I will pay that much money for my phone is I don't have to buy all those other products. OpenAI, Anthropic, XAI, which is part of Grok, which is SpaceX, on down the line. The promise is that, yeah, they're losing money now, but they're still in the early stages. You and I, once their products fulfill their promise, you're going to happily ditch all this other stuff, take $1,000, $1,500, $2,000, and you're going to roll it in and happily pay them for it, like you happily pay for this, because you don't have to buy a camera, you don't have to buy a video recorder, you don't have to buy a stereo. You've got it all in one device in your pocket. And so that's the positive spin on this. Now, you can argue maybe AI doesn't fulfill that promise. Maybe you still need to buy all this crappy software that we use right now. And then you need to buy AI on top of it. Well, then AI, you're only going to give them $20 at that point. But if I can do away with all that other software that I paid money for, and I could then say, now that you've freed up that budget, and look at how much more productive I am if I just tell my computer, just do this, do that, do this, do that. And what used to take me 2 hours takes me 10 minutes. I'm happy to pay that price for it. That's the hype and that's the promise of AI. I don't think that's too out of line right now, because what I've seen with using AI, and I'm deep into it, it looks like it could do some of this stuff. And that's why I'll conclude with Larry Page, one of the founders of Google, talking about AI, had a famous line where he said, I would rather see Google go bankrupt than lose the AI race. Because if they lose the AI race, Google is going bankrupt. You don't need a Gmail. You don't need, Maps. You don't need Sheets and all of their other products that they offer you. You don't need them. They're all going to be done by an AI context window.
I really appreciate the analogy. I really appreciate the positive spin on my probably pessimistic question, Jim.
It all comes down to how much will that technology fulfill its promise. Now,
absolutely agree.
Maybe it doesn't, and then it is way overdone. But if it does, then this is not insane. If it does.
It's not insane, but I think listening to you, I think this is the long term. This is kind of the long term narrative of artificial intelligence and where it wants to go. And I could see this absolutely playing out. I certainly could, but I do think this is not going to be a straight path, directly linear. There are going to be hiccups along the way. And we talked about, not having to pay for SaaS, software on one side and having that allocated to more an AI spend. And I think that's the question that's being asked right now, because it's apparent for plebes like you and I who spend however months a month paying for Claude or OpenAI. And I do. And I really like Claude. Like, honestly, I love Claude. It's been a huge lifesaver for me to streamline my workflow. I get it. And I pay them. However, I also come to understand that to keep this company going, it has to subsidize my user, the compute power that I use. Now, and if you're losing 70% to keep me subsidized, the business hasn't necessarily figured itself out yet. And I think that's where the short to medium term question is going to come. How does a market react when they realize that you and I are not paying what we should be paying for the amount of compute that we're using? And on top of that, I'm coming from metals and mining, and I'm the degenerate who then goes, well, if there's a big hiccup in the AI market and people realize that, this isn't profitable and maybe the data center spend gets crushed, what does that mean for the copper market if they realize the demand's not going to be there? So I'm thinking short to medium term, where your very thorough highly credible, optimistic view is certainly long-term, years down the road. Could we agree on that?
Yeah. So let me throw a couple of things at you. Yeah, they're subsidizing us at a loss, and they're going to expect more money out of us. Well, that's a business model that your average drug dealer does, right? He basically gives you, here's some free crack.
I don't know about your drug dealer. What are you
Yeah.
thinking, Jim? But
No. When you first go to a drug dealer, he says, "Yeah, here's some free crack. Enjoy it." And then once he's got you addicted, that's when the bill comes due. So they're offering us a little bit of free crack to all get us on it. And once we're addicted, then they're going to pull it back. And what does a junkie do to pay that drug dealer bill? He steals. And where are we going to steal from? SaaS. We're going to take it away from all the SaaS stuff that we pay for, and we're going to give it to them there. So that's the model. That's everybody's model. We'll give you a freebie for a while, get you kind of hooked on it, and then we'll send you the bill. So we'll see if that works as well. Now, let me offer you this. There's a thing called the Gartner hype cycle, where basically you run up into a big bubble of inflated expectations, then you crash, then you start to see reality. We saw this in 2000. I'll remind everybody in 2000. If it, the NASDAQ, I'll use the NASDAQ because I know those numbers. The NASDAQ peaked at 5,100 in 2000. And that was the hype. That was the big hype of the NASDAQ. Jeff Bezos in December of 99 was on the cover of Time magazine as the person of the year. And he was about the big promise of internet retailing. That was person of the year. What happened? The NASDAQ went down 80% from 5,000 to 1,000. Then what happened after that? For 10 years, the NASDAQ did not take out until 2010. It was still below 5,000. Where's it today? 25,000. 25,000 today is where it's at. So, yes, every new technology will run into a hype cycle. We'll go into a bubble, we'll crash, and then we'll take some time, and then eventually it'll be orders of magnitude higher. And that this one will be no different than all of those others. I would argue, to use that 2000 analogy, the pessimistic cases, it's March of 2000. We're right at the peak, and we're about to have the 80% crash. I think we're closer to where we were in December of 96. In December of 96, the reason I picked that date is that's when Greenspan gave his famous irrational exuberance speech. How do we know the stock market is not seeing irrational exuberance? This is out of control. The NASDAQ was 1,200 in December of 96. By March of 2000, it went to 2,000 or 5,000, excuse me. Then it went back to 1,100 by 2002. So I think we're closer to 96, 97. We're going to run up. You think this is insane? Wait till you see what's coming. And then we're eventually going to get to an out of control bubble. Then we'll have that 70 or 80% crash. You'll have plenty of time to buy in on that low, and then it will go up orders of magnitude higher. I'm just arguing we're earlier in this process. Part of that is that drug dealer thing. Here's some free crack. Get yourself addicted, and then I'm going to hand you the bill. And you're going to get the shakes if you don't pay the bill, because you absolutely have to have this product. And you're going to do it by selling off all your SaaS in order to use that money to pay for AI. That's the hope that they have for it.
Yeah. Let me ask you how market structure really fits into all this. Obviously, colleague, friend Michael Green has written a lot about the structure of passive investing becoming a whole behemoth in its own. But the argument that, that roughly half of U.S. equity assets under management are now passive, cap-weighted indexes, super high, leverage single stock ETFs complex, pulling these equities up by the bootstraps. Semiconductor exposure estimated to be about 20% of major industrial prime books. So, I mean, this thing is loaded up in this sector. But if the AI CapEx narrative cracks, how does this concentration amplify and unwind in your mind, whether it happens next week or 2030, as you mentioned?
Right. Well, first of all, the AI CapEx spend is not cracking for the moment because last week, at the beginning of last week, Google Alphabet raised $85 billion in for CapEx. Middle of the week, a smaller company, Supermicro, raised $7 billion, but they're a smaller company. But it was a big spend or big raise relative to the size of their company. End of the week, we got SpaceX with 75 billion of new money. And today's Wednesday. On Monday, NVIDIA did an $85 billion bond offering. It is, for the moment, they have the ability to raise an infinite amount of money, that there's no limit to the amount of money they can raise. Now, why is it that there's no limit to the amount of money they can raise? Because a lot of people in Silicon Valley think what I argued. This is the beginning of the biggest revolution in 150 years. And we have to be part of this revolution. So for the moment, there is no problem in raising that money. Now, the problem was, because they can raise unlimited money, they're going to ridiculously overspend on this. But they haven't done that yet. The data center pull or the data center build out is nowhere near being overdone because we don't have enough compute. We don't have it. We're not Global Crossings. Global Crossings is the fiber optic network. Global Crossings, everybody said, look, we got the internet. There's no amount of money we can't throw at these companies that are putting fiber around the globe, from California to Asia and back, from the East Coast of the United States to Europe. They're just laid fiber optic cable. By the time we got to 2000, we realized that they laid more fiber optic cable than humanity will ever use. And that like 80% of it is still dark. It's never been used. That's how much they overbuilt it. We're not there on data centers yet. We might get there. In fact, I say we will get there on data centers. I still think it's still several years off before we get to the ridiculous overbuild of data centers, but we're not there yet. I know people look at the raw numbers, but you got to understand what we're trying to do. We're trying to make every computer on the planet be tied in and use AI for everything we do. And we need more data center compute. That's why we have a shortage of compute. So we're going to get there right now. As far as the passive, I am very worried about the passive because that will feed into this narrative. A lot of people are arguing, oh, see, this is why you want to own an index, because I don't know what's going to win, but something always wins, and just keep throwing money at the market and just letting it continue to overbuild itself. The problem with that is when you throw money into an index, you're not discriminating against your investments. You're giving everybody money. Got a shitty idea? That's my word of the day. Here's some money. Got a good idea? Here's some money. Capitalism is supposed to be about taking away money from bad ideas and giving it to money that has good ideas. We're not doing that with passive right now. So we're looking at the AI thing. We're still early in the process. I still think it gets overdone. I just don't think we're there yet. And before it gets overdone with passive, we're going to basically throw so much money in indexes because I don't know what I'm supposed to buy, so I'll buy the index. Fine. I could be a shitty S&P 500 company and I'll survive because I could keep raising money because there'll be enough indexes out there that'll help me raise that money.
Yeah, no, exactly. It's been a fascinating evolution here the last 18 months here, Jim. Actually, the last time you and I chatted, it was a little over a year ago. And the conversation is really centered on a theoretical idea at the time that I think you coined it as the Mar-a-Lago Accord. Right?
I didn't coin it, but I helped popularize it.
You helped popularize it. Well, I it was a great conversation you and I had about those ideas. And so I thought it'd be interesting, given all the backdrop of the last 45 minutes that you and I have just chatted, and thinking back to a year ago where you and I talked about the Mar-a-Lago Accord, I thought it'd be kind of interesting just kind of see, all right, what is fitting together here in those two conversations? Like a year later, how would you grade the actual execution against the blueprint, whether theoretical, what's was theoretical and actually has come into fruition that maybe we have not necessarily seen because it's just been drowned by so many other headlines and narratives?
So the Mar-a-Lago Accord, let's talk about what it was. It was something that Stephen Mirren, who became a Fed governor, wrote about in a Hudson Capital report
Yeah.
before the election. It got a lot of attention because the guy that read the report and it resonated with was Scott Bessent, who eventually became the Treasury Secretary. Stephen Mirren eventually became the Council of Economic Advisors head and then became a Fed governor until he had to step down to make room for Kevin Warsh. So the Mar-a-Lago Accord basically talked about uh, the idea behind it was that we were going to reorient the world into some kind of a new dynamic. And it didn't have a name. They were kind of thinking like the Plaza Accord from the 1985
Yeah.
and stuff like that. So they kind of called it the Mar-a-Lago Accord because Trump was going to be at the center of reorienting the world. Had a couple of parts to it. And most of them have come to happen. The first one was to get the rest of NATO and the rest of the world to spend 5% of GDP on defense spending. Boy, we've seen that in a big way. Trump has been hammering the hell out of all of our NATO partners and all of our other allied countries to spend more money on defense. And they happily agreed that they will spend more money on defense. So that part has definitely come to pass in terms of the Mar-a-Lago Accord. Maybe a little bit of quibble about what is defense spending, but they're willing to do it. The second part of it was about government spending and whether or not that they were going to try and rein in government spending. The argument there was that we didn't have to rein in government spending. We're not doing that either. And the third part about it is as far as the dollar maintaining its status as a world currency, it continues to do that right now. So I would argue no one is calling it the Mar-a-Lago Accord per se, but all of the parts of it have been unfolding. The one part that hasn't happened, which we've seen, you could argue might have happened, is we haven't created a sovereign wealth fund yet. But we have a stake in Intel. We're talking about stakes in the AI companies. We're talking about a crypto AI sovereign wealth fund. We're talking about revaluing gold as part of the sovereign wealth fund. So even though that hasn't happened, that's very, very much a work in process with it right now.
Yeah. Do you think that's something that sovereign wealth fund is something that could happen in the later half of this Trump administration? I mean, they've already
Yeah.
set up the foundation for it.
Yes. I mean, it can. And I think it's a bad idea, as far as the way sovereign wealth funds work around the world is if you are a creditor country, that is usually it's around oil. You're a big oil exporting country and you create more dollars from oil than you could spend. You have no taxes in your country. Go to the Gulf state countries and stuff like that, or Norway. Hardly any taxes. Because they make so much money with oil, and then the excess money gets put into a fund, and the fund invests it. Okay, fine. We're not a creditor country. We're a debtor country. We get our money through taxes and through borrowing. So if Trump wants $1 trillion or $2 trillion sovereign wealth fund, where's that $2 trillion come from? We have to borrow it. We have to borrow it in the market. We're going to issue treasury bonds. We're going to take those treasury bonds. We're going to buy stocks. We're going to buy gold. We're going to buy crypto. We're going to buy all this other stuff. I don't think that the government stepping in and competing with capitalists for borrowing money and buying investments, because that's what they do, is a good idea at the end of the day. Because the government has an unfair advantage. It sets rules, laws. It has the power of a printing press, a central bank. And at the end of the day, it will force every bad investment to work, which will ultimately worsen the economy. Capitalism is about taking money away from bad ideas and giving it to good ideas. One of the ways you take money away from bad ideas is bankruptcy. Well, if the government buys a 10% stake in Intel and Intel blows it, Is the Trump administration going to allow them to go bankrupt? No. They're going to prop them up, and we're going to keep a bad company that we don't need around, and they're just going to make everything worse. I'm not saying that they are making mistakes. I'm saying, should they make mistakes? By the way, why do they have a 10% stake from the government? Because they've made mistakes in the past and got into a bad place to begin with, and Trump bailed them out by taking a stake in them. So I don't think that necessarily a sovereign wealth fund is for a debtor nation is a good idea. If we were a creditor nation, if we were producing so much oil that we had all this excess money we didn't know what to do with, that'd be a different story. But we're not that, and we're not going to be that.
Yeah. All right. Jim, great conversation as always. I always look forward to these hours we get once in a while to speak with you. I was really excited to kind of follow up on last year's conversation because that was such a huge idea. And people
Right.
actually, I mean, a lot of people like just literally stopped and like, holy shit, what does this mean? What's going to happen? And so it was kind of nice to kind of go back and see how that all kind of played into fruition. But, you know, again, it almost like kills me to record these things on a Wednesday morning, knowing that's going to publish on Friday because 24 hours makes a world of difference anymore. Like
Like I said, we're getting the worst press conference in 2 hours or 3 hours right now, and that could
right.
change things as well. And as a matter of fact, I'll tease you on this. You didn't ask me about it. I'll tease you on it real quick. I do think he's gonna announce a change at this conference. I think I'm speaking before. I think he's going to, the dot plot that the Fed puts out.
Right,
Uh,
right.
I don't think he's going to submit a dot. And he might try and convince some of his other colleagues to not submit a dot and do away with it. He's going to try and do away with it. He's going to try and get rid of the bias. The Fed's forward guidance, fancy word for tell me what you're going to do before you do it. They have this bias. They have a bias towards easing right now. They had 3 dissenters at the last meeting because they didn't.
Right.
They wanted he wants to do away with that language. Why does he want to do away with all that stuff? Because he believes that the Fed, and he's right on this, the Fed is a terrible forecaster. We always look at their forecast. Oh, the dot plot says they're going to cut rates 2 times next year. And that's the way we present it. No, the dot plot says a bunch of guys that are never right think they're going to cut twice next year. But that won't happen because they're never right. He's right about that. And he said, quit doing it, because what happens is we put out a dot plot. It says we're going to cut rates twice next year. Then it looks like we're not going to do it. But since we said we're going to do it, we have to torture ourselves into following through on this bad forecast. And it creates all kind of problems. So let's just stop doing it. So I think he's right on that spot. And that would be the thing I expect might come out of this press conference in a couple of hours. Now, why this one? Because if you submit a dot at this press conference and you submit a dot at the next one, you've validated that process. Then how do you in a year say, okay, now that I've submitted dots, I think we should stop submitting dots. End it now is basically where I think it could come from. So that's what I'm looking for in this presser. We'll see if he does it or not. But if he's ever going to want to get rid of that thing, it would be today that he would do it.
Mm-hmm. Mm-hmm. First time in 8 years, no Jerome Powell up on the podium. It's going to be It's going to be weird. It's kind of strange, but I like change. Sometimes I like change. This is going to be a good change. I actually am.
Exactly. And he's going to have a different approach. He's going to have a different, he does not like to answer. Remember, Powell would always answer Chairman Powell, if this happened and that happened, would you cut rates or hike rates or what would you do with rates? And he'd always be asked these theoreticals. I think that if you ask Wash that question, his answer would be, I don't answer those kind of questions. You got another question for me? Is basically what he's going to do.
Yeah. I expect him to ruffle a few feathers here,
Right.
especially this meeting, but in the next couple meetings, I think, as people kind of start to kind of feel him out to see, how he approaches the pressers but also the committee itself, because that's a whole nother story. Because, obviously the Federal Reserve is become incredibly political. It's not anonymous anymore. And so we'll see how
Well, that's the other thing. I'll throw this at you real quick. The other thing about what you could expect from the Fed, we are all used to, because for most of our professional life, the way the Fed works is the chairman decides and everybody else in the committee just goes along with him. That's changing because of Trump's attacks on the Fed's independence. What's happening now is the chairman is one of 12 votes. And he could say you need seven voters to have a majority. So the chairman could come out and say, I think we should do A, B, or C. The first question you got to ask yourself is, who are the 6 other people that agree with him? And there might not be 6 other people that agree with him on some of these things. That's why I don't think he's going to talk about cutting rates. Simply because if he stood at that meeting right now and said, we're going to cut rates at this meeting, the other 11 people would look at each other and go, there ain't 6 other people that are going to agree with this. And you're not going to, so it's not going to happen. In the past, the chairman would say, we're going to cut rates, and everybody go, you're the boss, whatever you want, you get. And that's not the way this Fed works anymore, I don't think. That's the other thing we're going to learn.
Yeah, exactly. Well, we will see. Jim, thanks so much for your time. Really great to see you. Safe travels to you.
Thank you.
There's a chance I'll be back in Chicago late this summer. If I can make that happen, I'm going to drop you a note, and we can
please do.
Finally have that beer and chit chat in person once again.
Maybe we go to Cubs game. Yeah, let me know.
Oh, that's my old stomping ground. I used to live on Lincoln and Addison area. So yeah.
Good. Nice. Very nice. Okay, good.
All right. Thanks, Jim. Appreciate your time. Yeah,
Bye-bye.
Me too.
Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.